Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson, and we broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. Always a pleasure to have Justin Bott from Services Australia. You also know them as Centrelink. And again, Justin, always happy for you to correct me on that. We know the subtle differences, but we may have new people listening, so please explain that away. However, we are in the run-up to Christmas, not long now, ladies and gents, and being that there is some considerations, and I'm reading my notes here, ladies and gents. Please just bear with me. My memory's not too good in my dotage, so. If you've got an ability to earn a bit of extra income and maybe supplement the age pension, Justin's here today to talk about what the new wage effect on your rate of payment may be, and are you going to be better off? Okay, Justin is the Community Information Officer at Services Australia, and we're talking today about the pension income test and how the work bonus could help. So, Justin, welcome to the program.
Thank you so much for having me.
Wonderful. So, look, we've spoken in the past about a pension income test. And again, it might be worthwhile having a bit of a refresh. So there's an amount of income that you can earn before your payment gets affected. So tell the audience a little bit about that.
Yeah, it's what we call the income-free area, which is exactly what you said. It's where income from all sources. So that might be wages, self-employment, investment properties, interest from bank accounts, that sort of thing, where income from all your sources gets together, and it's a point where it doesn't, not enough income to actually affect the rate of pension. So that's why it's the income-free area. If you're under that amount, what you earn isn't enough to actually affect the rate of pension that you're getting. It's $212 a fortnight if you're a single person. It's $372 a fortnight combined for members of a couple. So every dollar that you earn of income over those amounts on a fortnightly basis reduces your pension by 50 cents. So if I'm earning $213 a fortnight from all sources, then theoretically my pension goes down by 50 cents because I'm a dollar over that income-free area. And that sliding scale continues until your income is eventually too high and the pension can no longer be paid. So again, If I'm a single person, that's $65,020.80 per annum, and as a member of a couple, it's $99,382.40 per annum in combined income from, again, all sources before my assessable income is too high for the pension to be paid. Now, importantly, that doesn't include the impact of the work bonus. So the work bonus is separate to that and an added advantage of that. Now, it's also worth very quickly pointing out that is the pension income test. It's very different for allowances like job seeker payment, parenting payment, the other ones that we're doing.
Sure. I think it's well worth to mention at this point as well, Justin. I've just seen some recent numbers on what the numbers are on retiring comfortably on superannuation. And I really want to try and home in on this because some people have these inflated numbers. And it's like, guys, when you are not paying tax, okay, and that $99,000 that you mentioned, for example, is tax-free. Is it or is it not?
No. It's the $99,000 is the amount of money that you can have to still get some pension. And when you're at like $90,000 or so, the rate of pension is going to be very, very small. So it's going to be a very small amount of pension, but you still get some pension and the pension concession card. Your wages are a taxable income. Your age pension is a taxable income. So they're all potentially tax payable. Okay. The thing about tax, which hasn't got anything to do with Services Australia, but ATO, is that there is a special rule that exists for older Australians. It's called the Senior Australian and Pensioner Tax Offset. And in effect, it means that the amount of money that you can earn before you have to start paying any tax is significantly higher than it is for you or I who are under age pension age. So although you may still have a taxable income, one, it doesn't mean that you're actually paying any tax on it, or two, the tax rate still might be significantly lower than somebody else because of that Senior Australian and Pensioner Tax Offset. Right. But it does get to a point where they even out and you end up paying the same. If I'm earning $150,000 per annum in income, it doesn't matter if I'm over age pension age or not. I'm still earning $150,000 per annum. There's going to be a tax bill associated with that. So it's really sort of depends on how much you're earning and I guess where all that taxable income is coming from.
And I think it's worthy to note as well, ladies and gents, that there are a lot of indicators that talk about being able to live comfortably in retirement. And that number of 150K is well above that number of what it is assessed as, and we're not talking about the government saying this now, this is the industry that is suggesting living comfortably. Okay, now living comfortably will mean many different things to many different people. So it's always a fraught measure, because it's not a measure, is it really? It's a bit of a wet finger in the air.
Yeah, you're quite right, because everybody's retirement is different. As I will often say, that a person whose idea of retirement is fishing every river in a combi van around Australia is going to have much less resources required to do that than somebody who wants to visit the kids every 2 years while they're traveling overseas in England. So there's going to be much more in the way of assets required to fund one retirement over the other. And what we're talking about here, again, is income. And in particular, we're going to be talking about income from work, from wages, if you wanted to start a Christmas job. And there's a couple of quick points about that one. First of all of this, if you're on age pension age, or if you're on an age pension, this is all voluntary. So this is because you want to. Nowhere is there anyone saying that a person who's over age pension age or getting a pension has to work. This is entirely something that you want to do. And remembering, there are a lot of benefits of working when you're over 67 years of age. You've not only that extra source of income, and therefore not having to touch some of your resources, your superannuation or other bank accounts, because you've still got some income coming through. But there's all of the mental gymnastics and the engagement with other people that
absolutely
keeps the brain turning over, and all of that.
Move it or lose it. Yeah. Move it or lose it. Absolutely.
Now you might get that same benefit through volunteer work, but you certainly, if somebody wants to pay you at the same time, the whole point of something like the income test for the age pension and the work bonus is just to say that, yes, it may be that your pension is reduced because of the wages that you're getting, but it may be a lot less an impact than you thought. And certainly we don't want the pension to be a stopper from working. I don't want to work because my pension will go down. Well, yes, your pension may go down, but if you're earning a whole lot more than the reduction of the pension, then you're still significantly better off because you're working. Again, because you want to be working, not because anybody's making you go out and do that.
So how does Services Australia assess income for the pension?
Yeah, so what we're talking about here is, as that's important word, is that concept of assessable income. So it's not necessarily taxable income or even gross income. It's actually quite varied. So I guess the difficulty with income is that different sources of income are actually assessed differently. So it is your gross wage. But if you're running your own business, then it's basically your net profit from the business. So business income, allowable costs are taken into account.
Sure.
Just have to say that for both businesses and investment properties, there are some deductions that the Australian Taxation Office allows that we don't. So it's not exactly your taxable income there either. But it is mostly the profit that we'll be looking at. And then when it comes to a lot of the other income that you've got, which is your bank interest, your dividends from your shares, your payments from account-based pensions, interest from superannuation funds, or interest from loans that you've paid to other people, they are all what we call deemed financial assets. So we actually all add them all together and apply one universal interest rate, or it's actually a two-scale interest rate to that amount, so that we don't actually care what the dividends are or the bank interest is, because we have an income that we say those deemed financial assets are generating. So again, different sources of income are treated differently for Services Australia. So when we talk about accessible, it's really important to say that's the word that we're using for a reason. It's not what the ATO is taking into account. It's not what other people might be taking into account. It's how Services Australia looks at things. It's the part that matters.
Now, in my briefing notes, you mentioned a word called deeming. Can you explain to the listening audience what deeming means?
For sure. So deeming is the interest rate that we state, decree, or deem that your financial assets are going to be generating. Now, financial assets is just another term, same as deeming. So I mentioned them beforehand. They're investments that you may have your money in, like bank accounts, term deposits, shares, managed investments, superannuation if you're over age pension age. Most account-based pensions are also now deemed financial. Some very old ones are different, but most account-based pensions are deemed financial assets now. And what it practically means is that I don't care what the interest rate for your term deposit is. I don't care what the drawdown rate from your account-based pension is. You'll notice when you fill in an application for the pension that we actually aren't even going to ask the question about how much you're drawing down from your account-based pension, because we have an income that we say that you're getting Whether you're getting it or not is irrelevant. We're getting more than it or not is irrelevant. This is the income that we say that you're going to be receiving. And it's 0.25% and then 2.25%. So if you're a single person, it's 0.25% for the first 62,600 that you have invested in all of those financial assets, and then 2.25% for everything over that. For a member of a couple, again, at 0.25% for the first 103,800 in combined financial assets, and then 2.25% for everything over that. So if we say that you're 74 with an account-based pension and you've chosen to draw down 7% as the amount that you're taking from the fund, good for you. We don't care. The most we're going to say that you're generating from that in the form of income is 2.25%, and that's going to be the assessable income that affects your pension. So it's not your drawdown rate, it's the deemed interest from that particular fund.
So I see then, Justin, what you were talking about when you're talking about deeming and what you guys are saying compared to the tax office. The tax office would look at that income rather differently to the way you guys are looking at it to assess a pension.
Yeah, they do. I mean, account-based pensions, if you like, is another way to look at it, because for most people who are over 60, your account-based pension is actually tax-free. None of it's income for the ATO, but it is deemed for Services Australia. Gotcha. Whereas the ATO would be very interested in the exact dollar that you're receiving from your dividends. They've got the franking credits and everything that go with that. All of that's irrelevant for us. We don't care about what the dividends are. We're not particularly interested in when the dividends are paid, except for the fact that your bank account may go up and down as the money comes in, because we're going to deem it at the 0.25%, and it's fixed at those figures, 0.25% and 2.25%. It's fixed at those figures until the 30th of June 2025. So that's not changing anytime soon either.
It gives people a certain amount of certainty. So I guess this is where I'm actually going to learn something today, because we're talking about something that I don't know a lot about. So let's look at income from employment now. Can you tell us about the work bonus? Now, I've seen some of this in news reports, but I have to be honest, I haven't paid that much attention to it. So I'm really keen to understand what this work bonus means and why Christmas, for example, is a topical time that you want people to know about this.
Yeah, so the work bonus is one of those tools that the government has put in place to actually encourage people who are over age pension age to go back into the workforce if that's something that they want to do. And it's got two components to it. So I'll start with the easy one first. And the easy one is the fact that if you are receiving income from wages or eligible self-employment, we talked about the income-free area that everybody's got access to. Apart from that figure, the first $300 worth of income that you receive from wages or eligible self-employment will not count as income for Services Australia. So in effect, we ignore it. So that's $300 in your pocket with no effect in the pension at all. It's only the income that you receive over the $300 that could actually start having an impact. So first off, the first $300 for everybody who's over age pension age, whether you're on an age pension, carer payment, disability support pension, they're all pensions. If you're over 67 years of age and earning income from wages or that eligible self-employment, the first $300 we don't look at.
Per fortnight.
Per fortnight, that's right. And that can go for as long as you're working. That'll just keep ignoring that first $300 a fortnight. The second part is a little bit more complex part. If you have a fortnight where you're not earning $300, either the full amount or any of it, any of that unused $300 work bonus because you didn't work, it's added to a thing called your work bonus balance. And every fortnight you don't work or you don't earn that $300, then the amount that you didn't touch keeps getting added to that work bonus balance until eventually the work bonus balance reaches a maximum of $11,800. Now, and that can stay there forever. If you never work, you'll be on a pension for years and years. You'll notice you will keep sending you letters that say you have a work bonus balance, $11,800. It's just sitting there whenever you want to. The thing about the work bonus balance is that when you do start work again, the income that you receive from that wage, we'll go wage to make it easier, again, first have the $300 that we ignore, but then the amount over $300, instead of reducing your pension, reduces your work bonus balance first. And it's only when your work bonus balance actually gets down to zero that you start to see the rate of pension actually start to go down. Now, that's a bit complicated numbers. So it's always good to give an example because it'll make sense.
Well,
So
just let me hold you there for a moment. We're a little bit over time now for our halftime break. So look,
sure.
You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I have Justin Bott from Services Australia. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I have with me at the microphone again this week from Services Australia, Justin Bott, the Media Information Officer. This week we are talking about work bonuses, and in the run-up to Christmas, we're also talking about the ability for people that are over age pension age to go back to work if they want and actually earn some extra money without it impacting their pension, which I think is a wonderful idea. Because, Justin, one of those wonderful things we were talking about before we went to the break, and as I'm encroaching and getting closer to my own retirement age, this adage of move it or lose it, I think is a really cool thing, because this is kind of an incentive to older people to now say, hey, if you want to go back to work, go ahead, but we're not going to punish you for doing so. So look, before we went to the break, we were talking about the deeming. We were talking also about the work bonus. But now I want to move on to the assets test as well. And we were talking about concession cards. So I'll just throw back to you, Justin, in regards to the assets test.
So, yes, with the pension, we've got the work test, the income test that affects the rate of pension and the amount of income that you can earn. But we also have the other side of the story, which is the assets test. So in order for a person to be able to receive a pension, you have to pass both tests. You've got to meet the residency requirements. You've got to be over 67 years of age. But you have to have accessible income and accessible assets, both under the income test and the assets test. If your income and assets are too high, then a pension isn't payable. If one or the other is too high, the pension isn't payable. So you've got to be under both in order for a pension to be made. Now, in the same way that there is an income-free area, the amount of income that you can earn before the pension's being reduced, there's an asset-free area, which is the amount of assets that you can own before the pension starts going down. So again, for a single person, if I own my own home, that figure is $314,000 in accessible assets before the amount of assets I have starts to reduce the pension. If I don't own my own home, it's $566,000. If I'm a member of a couple who owns my own home, the figure is $470,000 in combined assets. And if I don't own my own home, it's $722,000. Which is the amount of money, again, that I can earn before my pension starts to be reduced. Sorry, not earn, own. The amount of assets I can own. Not income that I can earn. The amount of assets I can own before the pension starts to go down because of the value of the assets that I've got.
Now, I think it's really important. I mean, yourself in Canberra, we live up here in the Northern Beaches. The average cost of a house.
I'm going to put that in there. I'm a Northern Beaches boy. What are you talking about?
I assume you're from Canberra because you said Australia.
I'm Northern Beaches as well. Yes, I work for Services Australia, but I'm definitely a Northern Beaches boy.
There you go. I think I'm blushing, ladies and gentlemen.
You should be. And yes, I know exactly the sort of housing prices for the Northern Beaches that's in either.
What I'm suggesting, though, is that the actual asset price of the house, the family home that pensioners live in, never comes into play, no matter whether it's a shack around the corner or a piece of, ocean frontage on the Sydney Harbour that's worth 15, 20 mil. It pays no attention. Services Australia doesn't care about the value of that family home, do they?
In most cases, that is absolutely correct. The family home, if we talk about a homeowner non-homeowner and the amount of assets they can have. The family home in most cases and the surrounding 2 hectares does not count.
Yeah, the adjoining land.
Yeah. Now,
Yes.
if I've on the Northern Beaches and I've got more than 2 hectares worth of property, then well done me. But there are some circumstances where the family home does count, and that's particularly where I'm actually trying to basically run a commercial business out of it.
Oh, of course.
So, yeah. So apart from that, unless I'm doing that and trying to generate money, use the home to generate money, you're right. The family home, doesn't matter how much it's worth, is not counted as an asset for Services Australia purposes.
Right. So we've talked about the assets tests. Now, again, in my briefing notes, I'm seeing here that there are new cutoff points. Is this for assets? Those numbers have obviously gone up then, have they?
Yeah. So when the 20th of September, on the 20th of September this year, the age pension was indexed,
Right.
which means the rate of age pension went up, which means that people will have noticed that they've had an increase in their pension rate every fortnight. But when we fortnightly pension rate, that means that we also increase the income and assets cutoff points. So in the same way that the income cutoff points went up for the numbers that I gave in the first half, the asset cutoff points have gone up as well. And again, the cutoff points are the situation where pension can no longer be paid because my assets are now too high. It's actually worth looking at it from another way around. It's not that the pension can no longer be paid, but more importantly, I may now be eligible for a pension when I wasn't eligible for a pension before because I'm allowed to have more income and I'm allowed more assets. So the new assets cutoff point for from the 20th September 2024, again, if I'm a single person who owns their own home, now 695,500, not including the value of the family home. If I'm a single person who doesn't own my own home, it's $947,500. For a member of a couple who owns their own home, it's $1,045,500 in combined assets, again, not including the value of the family home. If I'm a member of a couple who doesn't own the home, then that figure's $1,297,500 in combined assessable assets for me to not have a pension eligibility anymore. So those figures have gone up. Decent increase after the 20 September change.
I guess what I'm curious about, Justin, I don't know if you've had numbers or even anecdotal evidence from the agency that you work with, but would it be fair to assume that a lot of people assume that they're not entitled to a pension and therefore never even ask, and then find out later on that they actually are entitled to a pension?
One of the reasons we're out here is to actually try and combat that exact problem. That there are certainly going to be a lot of people who think it's just not in their realm, why bother asking? And it is worth pointing out, because of things like CPI and because of the way that account-based pensions are designed to work, as a classic example, they are designed to use up your assets. Your account-based pensions are designed to eat into the capital, and therefore the capital reduces. And with CPI, those asset cutoff points grow. And it may well be that at 67, I don't have a pension eligibility. But just because I don't have one at 67 doesn't mean I'm not going to have one at 75 or 82, whatever it might be. Right. As my superannuation is decreased because I'm spending into it, and as my CPI is pushing the pension rates up because of CPI is doing that, they'll come to a point where they'll cross and I'll have a pension eligibility again. Now, if I'm engaging with a financial professional, I would be thinking that it's absolutely one of their jobs is to keep a track on how I'm going and what the new pension rates would be, fingers crossed, to make sure and give me notification to say, look, you are in the realm of it. So maybe it's time for you to apply. But ultimately, I am the customer. It's my payment. Services Australia is not responsible for getting people to apply. Our job is to make sure we tell people what those assets are and say it as far away as we can. But it's still up to you to then lodge an application to apply for that payment. So the times to check: 20th of March, 1st of July, 20th September. Always feel free to have a look at our website around those days, because the new figures will be there and you might find out you might be eligible.
I guess one of the fascinating things, my daughter at the moment is doing an internship with a market research company in the financial services industry, Core Data. And we've had Core Data on our show plenty of times before. Great purveyors of research and great information. I guess what really I'm curious about, though, because she came home and huzzah, she discovered all about superannuation. It was like, oh, Dad, look at all this fun. And I'm sitting there scratching my head going, I've only been trying to educate you for the last 15 years. She's almost 30, and it's like, guys, this is the reason why you got to know about this stuff. But I guess one of those things, you've just mentioned that she also came home at the same time saying, Dad, we don't have enough financial planners out there. And so when you talk about getting financial advice, I wanted to do a quick shameless plug for a service that you guys have with the financial information officers, because a lot of people find the idea of going to a financial planner quite daunting, because they read and quite rightly understand that to get a financial plan is, upwards of $3,500 to $5,000. But there's a much better way to go if they come to you guys first. Do you want to explain to the listeners about your service there?
It's not the same thing. So I really want to make that
no
very
doubt,
clear.
but it's a starting point. I'm not suggesting that you're doing in competition, but sometimes people just need the information and they don't necessarily find it on the web. They want to be able to talk to a friendly person and say, can you just help us out and get me started?
Yeah, absolutely. And that's exactly what the Financial Information Service can help do. So Services Australia provides the Financial Information Service, which is a free service that's available to anybody who's interested.
We love free on the show. We love free.
So it's available to anybody who's interested or has questions about financial issues. So importantly, you do not have to be a customer of Services Australia. So you don't have to be getting payment from us to see the Financial Information Service. In fact, ultimately, it's our goal that if we took somebody like your daughter who came in and sat down with us, the hope would be that we talk to a 30-year-old, teach them so well about investments and super and all that sort of stuff, so that by the time they actually get to retire, they're not ever going to look at a pension eligibility because they've managed to build up their own
because
wealth,
they've managed to build up enough for themselves. Absolutely.
Now, when it comes to the financial industry, we will see our role as an educator, because it's not an advisory service. So it may well be that part of the lesson that you learn is, I need to go and find a financial planner, because in some cases that is absolutely right thing for you to be doing.
But this is a starting point rather than the useless uncle at a barbecue that says, oh, invest in crypto or lithium. And we're going, no, don't listen to them. Go and talk to somebody that's, impartial.
So the thing about us is that it may well become very clear at the end of the conversation that you need to talk to a financial planner. But again, not because we say you should, but we will help explain what they do, what their services that they provide, and the language that they use. These are the products that they talk about. These are why they talk about these particular products. So don't get surprised if you've got a stack of money in superannuation that they're going to talk about account-based pensions, because that's what people talk about when you've got money in super. It's where the government designs your superannuation to go. So it's going to be talked about. Let's explain them and you understand what it is. So we're going to make that conversation with the planner that much easier, because it's now not foreign language for you. It's not foreign concepts.
Okay,
this free and impartial person's done it.
We're going to have to stop now, Justin. We're going to have to stop. We're so over time. But look,
I just got to say, make the appointment. You give us a call on 132300. Say Financial Information Service. That's how you make the appointment to see them.
Justin Bott from Services Australia. Always a pleasure. I think my editor's going to kill me. We're over time. But thanks so kindly for being on Dollars and Making Sense. Always a pleasure.
See you next time.